Gold, the ultimate currency. Winston Churchill once said, "The further back you look, the further forward you can see." For thousands of years, gold was the predominant currency for trade and store of value. In the Greek city-state of Athens, the world's first democracy, gold coinage blossomed and helped to fuel a booming economy. Athens flourished under this new system of money until decades of expensive wars drained its coffers. In a difficult position, the Greeks decided to make their gold coins with 50% copper, thus instantly doubling their money supply. Over the years, the percentage of copper grew more and more until finally the coins were almost worthless. Over the next 750 years, various Roman consuls and emperors did the same thing, inflating their money supply time and again. Two great powers of the ancient world, but one pattern of behavior that we see even today. For 2,400 years, we have seen a countless series of desperate governments dilute their currency until confidence in it was entirely destroyed. And time again, we have seen gold and silver, the pure precious metals whose supply is limited by nature, gain significantly in value. Today, more than 2,000 years later, Greece is again drawing attention for the wrong reasons, along with Italy, Ireland, Portugal, and Spain. Everyone's talking about the European debt crisis, about skyrocketing national debts, and about inflation. Could it be that history is repeating itself? It's not only European countries and Japan that are fighting with out-of-control government deficits. The United States is now the world's most indebted nation. The $14 trillion that it now owes is almost 100% of its GDP. If one adds in the massive debts from private borrowing and healthcare, the total debt load comes to a stunning $55 trillion US. When we think of modern currencies, we think not of gold coins, but of paper. Paper which we can only have confidence in if we know what it stands for, its current value. When this confidence is destroyed by reckless or desperate governments, paper currency isn't even worth the paper it's printed on. As 2010 drew to a close, the price of gold reached an all-time high of $1,400 US per fine ounce. That's impressive, but it leads to the next question. What will the price of gold be in the future? Investor legend Jim Rogers sees the price of gold at more than $2,000 over the next decade. Mark Faber, the market expert, sees an even higher price ahead for gold, $5,000. Hedge fund manager John Paulson sees renewed inflation potentially driving gold to $4,000 an ounce. Superfund founder and owner Christian Baha, who has long warned of the dangers of inflated paper money, has been recommending gold in recorded interviews going back as far as 2003. Then as now, he's a believer in the world's ultimate currency, gold. For this reason, Superfund has for years been finding new ways to anchor its funds in the stability that only gold can offer. As early as 2005, Superfund launched the world's first fund to be virtually denominated in gold, thus opening new opportunities to investors to protect against inflation and ensure the long-term value of their assets. It may be a long time before the world's governments return to the gold standard, but Christian Baha, himself the largest single investor in Superfund funds, particularly the gold share classes, has brought the gold standard back into the world of investment. And the results speak for themselves.